Okay, hi there, and welcome to another video. And in this short revision video, we'll take a look at how the government can generate revenue from direct taxes. So direct taxes are paid directly by the individual or a business to the government. The key point is that the burden of a direct tax cannot be passed on to somebody else. Now, this is different to finding ways to legally avoid or illegally evade tax, but crucially the tax liability is yours and yours to pay. And they're nearly always taxes on income, including corporate profits and also wealth. Now here are 5 examples of direct taxes in the UK. Income tax, which we'll go through in a second. Corporation tax, a tax on business profits. Capital gains tax. This is a tax on the profit when you sell or dispose of something that is an asset, perhaps some shares that have increased in value. National insurance is paid on income by the employee and the employer, and inheritance tax, or IHT, is paid when a person's estate is worth more than a threshold level when they die. Income tax in the UK is an important idea. This is how income tax works in terms of the marginal tax rate rising with income. Okay, so you all have a tax allowance of £12,500, and then beyond that you start paying tax at 20%, 40%, 45%. The marginal tax rate is the tax on the next £1 of income that you earn. So let's take somebody on £35,000 a year. They would be paying no tax on the first £12,500. Then the next £22,500 is taxed at 20%. So they would pay £4,950 in tax. What about somebody on double the income? Well, they would pay no tax on the first £12,500. They'd then use up the whole of that little next bit. They use up the whole up to £50,000. So they pay 20% of £37,500. Which, if my maths is correct, is £7,500. They've still got £20,000 of taxable income left, so they'd pay that at 40%, which is £8,000. In total, they'd pay £15,500. And finally, let's look at somebody earning a lot of money, £4,000 a week, £200,000 a year. Again, no tax on the first £12,500, although in fact they would lose that allowance technically. But for this purpose of this video, they don't pay tax on the first £12,500. Then they pay all £37,500 at 20%. The next £100,000 they use up again, they pay that at 40%. They've still got £50,000 above 150,000. So got £50,000 to pay at 45%. So you can see here that they're spending a lot of money on tax here. In total, in fact, they're going to spend £70,000 on tax. Let's see how these figures add up. So the person on £35,000 a year pays £4,950. That's an average tax rate of 14.1%. Double the income to £70,000, they pay £15,500 in income tax. That's an average tax rate, just dividing one by the other, of 22%. Somebody on £200,000 a year pays £70,000 a year in income tax. Again, divide 70 by 200, that gives an average tax rate of 35%. In other words, with a progressive tax, which income tax is, the average rate of tax goes up with income. These 3 example calculations show that income tax in the UK is progressive. In other words, those people on higher incomes pay a bigger percentage of their income in tax. Here are the 5 big direct taxes we've mentioned today, and income tax brings in just under £200 billion a year. National insurance not far behind. Those 2 form the bulk of the income from direct taxes. In third place, corporation tax, just under £60 billion a year. There was more than £1 billion a week in tax on business profits. Actually, for all the media coverage of capital gains tax and inheritance tax, they don't actually bring in much in the form of revenue compared to those big 3 leading direct taxes. Just want to show you a couple of slides to finish with from the Institute of Fiscal Studies. This chart shows direct personal taxes, that's income tax and national insurance, as a share of GDP. compared to all the other taxes, including indirect taxes. And you can see that in the UK, on the left-hand side there, direct personal taxes bring in just under half of the total tax revenue for the government. It's relatively low, certainly compared to the OECD average. And notice too how in Scandinavia, Sweden and Denmark and those countries, the tax burden is much higher, certainly contrasted with the United States, but the ratio between direct personal taxes and all other taxes is significantly higher. Those countries have very progressive income tax systems. And this chart just gives you an illustration, a nice visual illustration for understanding the concept of the marginal tax rate applied to extra income. So you have your tax-free allowance, then national insurance kicks in, then the basic rate kicks in, then the higher income tax rate. So as your income goes up, you become liable to pay a higher marginal tax rate on income. Note the spike in the highest marginal tax rate, because as annual gross income rises above about £100,000 a year, then the income tax-free allowance is gradually withdrawn, which means effectively those people are paying a tax rate of over 60% on earned income above £100,000 a year. But it gives a nice feel for the marginal tax rate, which of course leads to the average going up. So there we go, a quick journey through aspects of direct taxation.